Uncle Sam does not control your taxes. You do. You can decide how much in taxes you are going to pay to the government. And I want to show you how to do this with tax-efficient investing. A lot of people think that investing is all about growth, but they miss one key component: after-tax growth. How much money will you have after paying all of your taxes? This is the most important part about investing, and not too many people understand this. So today I'm going to give you 10 simple rules to follow for tax-efficient investing. Once you master these simple concepts, you will be able to sit in the driver's seat of your taxes and literally decide how much you are going to pay. My name is Sherman the CPA, and I help people save thousands in taxes from these types of strategies every day at mycpacoach.com. So be sure to save this video, comment below if you have any questions, and be sure to subscribe for even more tax strategies. All right, rule number 1, understand your tax bracket. If you want to control your taxes, you need to understand what your current tax rate is. So take a look at these 2024 tax brackets and find your federal income tax bracket right now. Now, there are 2 ways your investments can be taxed. It can be taxed as ordinary income, which ranges from 10 to 37%, or it can be taxed as long-term capital gains, which can be taxed anywhere from 0 to 20%. Now, I'm going to show you how to take advantage of low tax rates just like these and many other ways to reduce your taxes, so just stay tuned here. But for right now, I just want you to find your income, the ordinary tax bracket that it falls in, as well as your long-term capital gains tax bracket. Now that you have these 2 numbers, we can start working your taxes down. Rule number 2, diversify your tax structure. Okay, so just how diversifying your stock portfolio limits your risk, diversifying your tax structure also allows you to lower your taxes. You can do this by utilizing 3 types of investment accounts: taxable accounts, tax-free accounts, and tax-deferred accounts. Now, each of these accounts are taxed differently, which means if you use a combination of all 3 of these accounts, you will have maximum control and flexibility over your taxes. This is because when you need money from your investments, you can decide which of these accounts you want to pull from and choose the lowest tax rate. So let's talk about some basic features of these accounts to make sure you understand this. I want you to think about these 3 accounts like buckets. Bucket number 1 is your taxable account. This is just your regular brokerage account that you may have at Vanguard, Fidelity, Schwab, Robinhood, or wherever. Now, with taxable accounts, you trigger taxes when you sell your investments. But when you do sell, you may qualify for lower capital gains tax rates, which you can then use to reduce your taxes significantly. And not only that, these accounts also give you maximum flexibility because you can withdraw your money at any time. None of these other accounts allow you to do that. Bucket number 2 is going to be your tax-free accounts, like your Roth IRA, Roth 401k, or 529 plans. Now, all of these accounts are funded with income that has already been taxed. And the investment income generated is also tax-free when you start making withdrawals from it. But there are restrictions on when and how you can withdraw your money, such as reaching a certain age or using the funds for certain expenses. And bucket number 3 is going to be your tax-deferred accounts, like your traditional IRA, 401k, or HSA. Now, these accounts are funded with pre-tax dollars, meaning you get a tax deduction for simply putting your money into them. You are basically pushing income off of your tax return this year far into the future. But when you do withdraw your funds in the future, you will pay ordinary income tax on all of your investment income when you start making withdrawals. And there are also restrictions on when and how you do withdraw your money. Now, trust me, regardless of how you feel about any of these, there is a time and a place to use all 3 of these accounts to minimize your taxes. And if you stay with me here, you are going to learn the what, when, and how. So let's start by going over the ways you can do this with your taxable account. Rule number 3, do not sell your investments unless you absolutely have to. With a taxable account, it is important that you understand when you are taxed. You do not pay tax when your investments rise in value. You only owe tax when you sell them, which means if you never sell them, you will never owe taxes. Furthermore, If you fully understand how compound interest works, then you already understand the importance of not interrupting it, which allows your investments to grow to the highest possible upside. Now, to accomplish this, all you have to do is choose long-term investments that you can hold for decades on end and require minimal trading, like index funds, for example. This will allow you to benefit from the appreciation of your assets while minimizing the amount of taxes you pay along the way. Another thing you could consider is borrowing against your assets with a portfolio or securities-based line of credit. When you do this, you will pay no taxes on the cash you receive because loans are not considered taxable income. But you would have interest expense and run the risk of having to pay the loan off in the future, so weigh this option carefully. Ultimately, if you must sell your investments, only sell what you absolutely need or have a plan for. Because if you can minimize your selling, you can minimize your taxes. Rule number 4, avoid short-term capital gains at all costs. Because you will pay tax when you sell investments inside of your brokerage account, it makes sense to sell them at the lowest tax rate possible. And there are two primary rates that apply here: short-term or long-term capital gains tax. Short-term capital gains are taxed as ordinary income, which ranges from 10 to 37%. We do not want that. Instead, we want long-term capital gains, which are taxed at 0 to 20%. For example, a single taxpayer with $200,000 in income would pay 32% in taxes on their investment gains. Whereas if it qualified for a long-term capital gain, they would only pay 15%. That is a 17% difference in tax rates, or $17,000 in taxes saved on a $100,000 gain. Okay, so how can you get your investments to qualify as a long-term capital gain? All you have to do is hold your investment for greater than 12 months. And if you do, when you sell it, it will qualify as a long-term capital gain and have lower tax rates. This is very easy to do, again, if you make long-term investments into low-cost ETFs or index funds. But if you frequently trade individual stocks or day trade, then I would suggest doing this from a tax-free or tax-deferred account, which we will talk about in a little bit here. Rule number 5, time your long-term capital gains for the lowest tax treatment. So long-term capital gains are obviously taxed at lower rates, but you can also optimize your investments to sell for the lowest possible capital gain rate. So yes, these rates range from 0 to 20%, but a 0% tax and a 20% tax is very different. So look, the lower your taxable income is, the lower your capital gains rate will be. For example, let's say you want to sell an investment for a $50,000 gain. If your taxable income is less than $94,000 as a married couple, you would pay 0% in taxes. If it is above this, you would pay a 15% tax unless you earn over $730,000, then you would pay the 20% tax. So if your income fluctuates year to year, or you expect to be in a lower capital gains bracket in the future, time your capital gains to benefit you the most from a tax perspective. Rule number 6, prioritize appreciation over dividends in your taxable account. There are two primary ways your investments can grow your wealth: through appreciation or income. Usually funds that prioritize appreciation, like growth stocks, have low dividends. And usually funds that prioritize income, like dividend stocks, have lower appreciation. So there's usually a trade-off for investment purposes, and either may be more appropriate for you based on your objectives. However, from a sheer tax perspective, we prefer appreciation because you do not pay taxes when your assets appreciate in value, and you pay lower taxes when you sell them. For example, if your stocks grow from $1,000 to $1 million, you would pay no taxes as long as you do not sell it. And if you need to sell it, you can choose the best timing for the sale, perhaps when your tax rates are low, and you can choose the exact amount you wish to sell and pay tax on. You don't have to sell the entire amount. On the other hand, dividends and interest income work the opposite way. It forces you to pay taxes. There is no way to shield your dividend and interest income from taxes through a regular brokerage account. You cannot control the timing of your dividends. You cannot control the amount of your dividends. And if you are not careful, you can end up paying much higher tax rates. For example, ordinary dividends, interest income from high yield savings accounts, and income from money market funds are subject to ordinary income tax rates up to 37%. The only exception are qualified dividends, which may be taxed at the lower capital gains rates. But otherwise, if you are going to earn income subject to ordinary income tax, then you will be better off moving on to this next one here. Rule number 7, use tax advantage accounts for high tax investments. Ordinary income tax is the most expensive tax you can pay. And investments subject to this tax include savings accounts, CDs, money market accounts, bonds, ordinary dividends, and short-term capital gains. If you earn any of these types of income, then it is best to invest into it from a tax-protected account. If you use a tax-free investment account, you will pay 0 tax on all of your investment income. Or if you use a tax-deferred account, you will only pay tax on qualified withdrawals you make in the future. You may use a combination of these accounts depending on your circumstances in any given tax year, but let's go over some general best practices for you to do so. Rule number 8, use tax-free accounts when your tax rate is low. When you use a tax-free investment account, your investment income is tax-free. Again, these are accounts like Roth IRAs, which are individual retirement accounts, Roth 401ks, which are employer-sponsored plans, and 529 plans, which are savings accounts for your child's education. Now, while your investments in these accounts do grow tax-free, it does come at a cost. And that cost is that you must pay taxes on the income you use to fund these accounts up front. You're basically paying taxes now on the income you earn to not have to pay them on your investment income later. And this can be very expensive, especially for those who are in the highest tax brackets. Someone in the 37% tax bracket today who will be in a 12% tax bracket during retirement may end up paying way more taxes using a tax-free account as opposed to a tax-deferred account. Therefore, the lower your tax bracket is, the more you will benefit from tax-free accounts. As a general rule, these accounts are best when your current tax rate is below 20%, but can still be helpful when you're in the 20 to 30% range as well. When you go beyond this though, a tax-deferred account is usually much more beneficial. So let's talk about it. Rule number 9, use tax-deferred accounts when your tax rate is high. When you use a tax-deferred investment account, you are pushing money off of your current tax return into the future. You get to deduct the amount that you put in, and you only pay taxes when you start withdrawing from it later. And again, the most common tax-deferred accounts include traditional IRAs and 401ks. It also includes pensions and defined benefit plans, as well as health savings accounts. Now, here's the thing, whether you pay tax today or later, you are still paying ordinary income tax when you use these accounts. And most people believe that tax rates will only become more expensive over time. Because of this, we only recommend these accounts when your taxes are already very expensive, usually when your tax rate is above 30%. Although it may still be beneficial in the 20% range as well. Now, let's talk about how to control your taxes from everything that we've discussed so far. Rule number 10, liquidate your most tax efficient investments. When you need money from your investments, you should pull it from the sources with the lowest tax rates. And everything we've discussed so far will give you the ability to do this. You will have maximum flexibility and control over when you want to trigger taxes. For people under 59 years of age, you are probably already earning income from your job or business to support yourselves. Therefore, if you absolutely need money from your investments, the best options will likely be to sell your investments at a long-term capital gain or borrowing against investments that are already in your portfolio. For people above 59 years of age, You will likely pull from your tax-free accounts first, since you will owe no tax on those withdrawals. Or if you are in a low tax rate at the time, you may decide to pull from your tax-deferred accounts, since they are subject to ordinary income tax, which may be low based on your income in that given year. Or finally, if your tax rate is high at the time, you can instead turn to your taxable account and sell some of your investments for a long-term capital gain, which has a much lower tax rate. Folks, everything that I just told you will give you the ability to choose how you want to be taxed when you start withdrawing money from your investments. So if this helped you at all, please subscribe and like this video. And if you need immediate help with anything related to saving money on taxes, go ahead and go to mycpacoach.com to apply to work with one of my CPAs today.